And open it up. All right, I'll just let people join and then we'll get started in a moment. Great, I see them filling in now. All right, I'm sure some will continue to join over the first minute or so, but I'd like to go ahead and welcome everyone. Thank you for joining us for our Q2 2026 Financial Markets and Portfolio Update. Today's session will be led by Steve Galley, our Chief Investment Officer and Wealth Management Advisor, who will share insights on the current market activity, trends, and key considerations. As a reminder, we encourage you to submit your questions throughout the session using the Q&A feature in your Zoom toolbar, and we'll address as many as we can at the end of the discussion. So with that, I know there's a lot to cover. As always, I will turn it over to Steve.
Thank you, as always, Katie, and welcome everyone. Thank you for joining. Lots to cover today. As usual, we really hope to make this as interesting and informative as possible. And if anyone has any feedback about what you'd like to see next time, please let us know. So for today, we always like to start off with some fun and interesting facts. Then we'll be talking about what's been going on in the markets. We'll present the bull and the bear cases. And then, of course, we will talk about what that means for the portfolios that we are managing. So I don't know. I think I've heard a lot from a lot of clients who have kids, who have teens, that it's really, really hard to get internships, especially if you're 18 or 19. And I think it's pretty interesting when you take a look at the demographics of this country. And I wasn't really aware of this, but apparently right now there are more 18-year-olds in the United States than ever before. And sometimes it comes down to supply and demand. And unfortunately, there's a lot of supply of 18-year-olds right now in this country. And a lot of people will say, well, wait a minute, I thought, the baby boom was long past, et cetera. So really what's behind this is that before the great financial crisis, there was actually a huge immigration surge into this country. So net immigration, including undocumented immigrants, was at a historically high level in the mid-2000s. And many of those immigrants brought young children or were young themselves. So there were a lot of births going on, and that is what actually contributed to what we are seeing right now in terms of the spike in the number of 18-year-olds. Now, I have a 19-year-old myself, and this summer he's actually going back to the college that he just came home from for an immersive summer program. So it's kind of like I have to pay tuition all over again this summer. Thank goodness for 529 plans. But ideally, actually, that as you can see by the forecast, it will decline over time. So hopefully there will be a little easier to get internships in the later summers. Also, I think this is a fascinating slide about if you look at what the top 10 companies by market capitalization have been at the start of 1985, 95, 05, 2015, and 2025. It's really incredible to think about how concentrated the market is today versus in the past. Right now, the top 10 companies make up almost 40% of the entire market, of the entire S&P 500. Just 10. So that's incredible. But what's really interesting is that those top 10 companies, in other words, the largest companies, have changed pretty dramatically over time. Right now, the biggest companies are tech, right? And what this is really telling us is capital markets self-correct. It kind of is, if you are an incumbent and a leader, inevitably that attracts competition, rivals, regulation, and challengers will be nipping at your heels. So when you're a big firm and you're one of the biggest, you will have competitors coming after you, and that plays itself out. So it will be interesting to see if a lot of the top companies of today are still at the top in 2035. But I think it's really important because some clients always talk about, I have to be in this company, own this stock or that stock. Well, one thing this really reminds us is that it's easy to look at today's winners, but it's definitely difficult to know what the future winners will be. Okay, so let's talk about some of the big headlines that are coming through. I think it's pretty clear that if you've gone to the gas station lately or have gone out to eat, inflation is still a problem in this country. So if you look at the tail of the tape here, we obviously had a massive inflation spike in mid-2022. And Jerome Powell, who had led the Fed at that time, was talking about how, oh, it's transitory. Well, it turned out it wasn't very transitory. And to Jerome Powell's credit, he did hike interest rates very, very fast to get inflation back down. But the Fed's stated inflation target is around 2%. And as you can see, we are nowhere near that 2% target. As a matter of fact, and this is obviously has to do a lot with the spike in energy prices, we are now heading more towards 4%. So that is something that is going to make it very difficult for the Fed to cut rates. As a matter of fact, odds are that the next rate move by the Fed may be to increase rates. So we will talk a little bit more about that. Some of the other headlines that have been popping through are all about private credit. So do we need to worry about that? What is private credit? Well, in a nutshell, private credit is direct lending to companies or borrowers by non-bank lenders. So these are outside of the public debt markets. So the lenders, which is usually a private equity firm or a specialty finance firm, they negotiate loans directly with borrowers. And these loans are usually held to maturity. They are generally illiquid. And a lot of the borrowers are middle market companies that can't access the public markets, or they prefer the speed and flexibility of a private deal. But just like in our country's history, if banks make bad loans, banks get into trouble. Well, the same thing can happen with companies that loan money in the private markets. And unfortunately, there have been some instances that have been popping up where some loans have been made that aren't doing so well. But one of the reasons that private credit has grown so fast, and you can see on the left-hand chart here, after the global financial crisis, bank lending went down dramatically. A lot of that had to do with regulations surrounding banks to make sure that there weren't any, that there were more safeguards in place. And as a result, that corresponded to the growth in private credit because someone had to step in and fill the void. If banks were pulling back on lending, private credit firms stepped in to provide that lending. So it remains to be seen if some of the issues that we're seeing in the private credit market will spill over and actually cause ripples in the larger public market. So let's also talk about what's happened year to date so far, because year to date, stock market performance has been fantastic, right? And so this chart is sorted by the year to date return represented by various indices. So you'll see at the top, emerging markets are leading the pack. And why actually are emerging markets almost at 20% year to date? Well, a lot of that has to do with the fact that emerging markets are looked at as sort of another way to play the artificial intelligence trade. A lot of business is done in the emerging markets in terms of the supply chain for semiconductors. Taiwan Semiconductor is a great example of a company that's located in Taiwan. Taiwan is an emerging market. And so emerging markets have benefited from the fact that there is so much spending going on to build out AI infrastructure. And that's obviously showing up in the return numbers. Small caps represented by the Russell 2000 have done really well this year, up almost 14% year to date, whereas the broad S&P index so far to year date is up just over 9%. Now, unfortunately, bonds represented by the Bloomberg Ag at the bottom here are actually negative year to date. And so what is that? Why is that? Well, if you look at this chart about this is the US Treasury yield curve. The blue line is where we were at the start of this year. And I guess that's a darker blue line is where we are basically today. And the green line represents what the futures market is telling us where futures expect interest rates to be a year from today. And what this is telling us is that pretty much at every maturity level, yields or rates have gone up. And it's an inverse relationship. When rates are up, prices go down. So even if you're holding a bond that pays, let's say, a 4 or 5% coupon, unfortunately, the return you're getting on that interest has been wiped out by the price decline as a result of the rates going up. So unfortunately, bonds haven't really done very well this year, and that's why you see that dynamic playing out. And I think, as we were mentioning, the real question is, where are rates going from here? It seems like the markets think rates actually may go up. And again, a lot of that has to do with the fact that inflation is still a problem. And if there's one thing that bond investors hate, it's inflation. So turning back to stocks, one thing we've been thinking a lot about is, are things overheated? So we've tracked a lot of research on this, and there was some really interesting research put out on whether certain company valuations have got to the point where they're considered ludicrous, meaning way out of line with reality. And so what is the criteria to make a ludicrous list of companies that are way overvalued? Well, first, the criteria is, has the stock gone up over 100% in the last year? The second criteria is, does the stock trade at a price to sales ratio of over 10 times? Meaning, if the company makes a certain amount of revenue, you have to pay 10 times that revenue to buy that company stock. And by the way, is 10 times really high? Yes, because in actuality, the S&P 500 companies on average only traded about 2.5 to 3 times their revenue. And the other criteria is that we're only looking at companies that are pretty big, meaning a market capitalization of over $1 billion. And I think right now, what's kind of scary is that there are 125 companies out there that qualify for this ludicrous list. Now, historically, going back even several decades, usually only a very small number of stocks fit all of that criteria. So the fact that there are so many companies right now that, for all intents and purposes, have somewhat of a ludicrous valuation is a bit of a concern and starts to raise the specter of perhaps a bit of a bubble forming. Everyone knows I love this chart. I think I talk about it every time, but I think it's very important because this looks at what is the price to earnings ratio of the market. So this is actually what things looked like a year ago. And just as a reminder, the 30-year average of the S&P 500 forward PE ratio is right around 17 times. In other words, you have to pay 17 times earnings to buy a stock, right? And so usually, and 66% of the time, the market's trading between 20 and 14. But last year at this time, we were pretty much right above that 20 zone, right? Somewhat still uncomfortable in terms of a high level. And that was actually after we had a bit of a dip. Remember, we had the big tariff kerfuffle in March of last year, and that actually brought the PE ratio down a bit from where it was elevated above a 22 number. So where are we today? Almost the exact same place. We are still at elevated forward price to earnings ratio. And as I always say, the market cares the most about earnings. When we buy stocks, what we want to buy is we're buying the future earnings potential of that company. So what the market is telling us right now is we've got to pay a lot of money to buy stocks, even if their earnings are high. So the real question is, are those high earnings justified, right? And so I think this is an interesting headline in the Wall Street Journal only about 3 weeks ago that said, earnings season so far has been great, but why might that be a reason for caution? So remember, the market always looks ahead. And even though the first quarter has shaped up to be one of the best earnings season we've seen in years, The reason that that's problematic is because usually when you have amazing earnings growth, it is usually after you come out of a recession, because during a recession, a lot of companies actually sometimes have negative earnings. So it's easier if you're coming out of a negative earnings environment to show good earnings growth because you're coming from a very small or negative number. But the amazing thing is that today we are seeing amazing earnings growth, and we haven't had a recession in several years. So the fact that we have this incredible earnings growth and we're not coming out of a recession is pretty unique. And there are some very maybe cautionary analogies that we can look at in terms of history. Back in 2000, and this was before the dot-com bubble burst, consensus, in other words, what all the analysts do who cover stocks, said that they thought earnings growth was going to be 15% year over year. In actuality, that ended up only being a 4% growth number. Very disappointing. And then we know what happened after the dot-com bubble. Back after and during the right before the great financial crisis, it was another double-digit earnings estimate number of over 16% is what the analysts thought. And the scary thing is actually earnings declined by 75%. And of course, then we had several years of negative market returns after that. So where are we now? Well, analyst expectations for 2026 is that we are almost going to have 20% earnings growth. We don't know how that's going to play out this year or whether that is going to come to fruition, but and hopefully we do not see history repeat itself in terms of a dramatic disappointment. That's one reason for caution. One other question is, well, where are all these earnings coming from? Well, this is an interesting chart talking about hyperscalers. And first of all, who are the hyperscalers? Well, hyperscalers are the large cloud computing companies that own and operate data centers, which have thousands of servers in them, that along with cooling and data storage capabilities enable those hyperscalers to house and operate tremendous artificial intelligence workloads or compute. And the spending by the hyperscalers has been incredible. And that spending has gone to all these companies that are supporting that infrastructure build out. Now, the interesting thing is that that spend is forecast to even be higher next year and the year after that. And what the hyperscalers are doing is they are basically using almost all of their free cash flow to do it. So instead of actually giving that cash flow back to their shareholders, they're reinvesting into the business to build out this AI infrastructure. Now, why that might be problematic, and this there's some really good research from our friends at Goldman Sachs on this, and they kind of call this the quiet alarm, and they called it a reality check. And when they dug into the numbers, they found that all the AI investment in 2025, which was at least $700 billion worth of capital expenditures, really didn't contribute anything to US GDP growth. That's a little problematic. And the other issue is that the market is expecting all this spend to result in benefits and earnings later. But we haven't really seen that yet. So the analogy, which I think is interesting, is that the telecom companies back before the dot-com bubble birth were building out their infrastructure like crazy. They couldn't lay down fiber optic cable fast enough. It was massive CapEx spending by them. They said that everyone is going to need 5G. 5G is going to be the greatest thing in the world. As a matter of fact, today, if you ask anyone if they're on 4G or 5G, they probably don't even know the difference. And that ended quite badly. They overbuilt on infrastructure. And then, of course, we saw a lot of these telecom companies go out of business. Similar to today, the hyperscalers are doing this build out, and they are telling us that, don't worry, all these killer applications for artificial intelligence will come, and they will generate massive amounts of revenue to justify all this spend and all this productivity improvement. Maybe that happens, maybe it doesn't, but it is a very interesting analogy to draw. There is a big difference, though. A little bit of a source of comfort is that before the dot-com bubble, a lot of the telecom companies were using lots and lots of debt. In other words, they became very leveraged, which magnified the problems once the problems started. So the fact that the hyperscalers are actually not raising a lot of debt now is a good thing. However, there is a lot more debt expected to be raised by those same companies as this build out continues. So I think that is really something to keep an eye on. So just to sum up some of the points that I've been making here, and I won't read all these bullet points, but I do think that that it is something we have to keep an eye on. And if all this spend doesn't result in both strong earnings and productivity gains and all the other things that the market seems to think is going to happen, I do think that that will be problematic for the market. Now, not to be overbiased here, have to present the other side of the coin here, which is the good counterpoint right now is that this is an interesting chart that looks at consumer confidence and inflection points in consumer confidence. So the dark gray line is tracked by the University of Michigan and consumer sentiment, known as the Consumer Sentiment Index. And what this tells us is that normally, when the Consumer Sentiment Index hits a bottom point, that's a great time to invest. Because why? Well, investors, when they feel gloomy, the natural tendency for investors is to pull back and get out of risky assets. History tells us that that is a mistake. History tells us that if you invest during bottoms in sentiment, that your subsequent returns are usually quite strong. So here we are right now at a pretty low level of consumer sentiment. So if history is any guide, perhaps that is a bullish indicator for the future. But one question also is, well, why are people gloomy, right? And I think that goes all the way back to the inflation problem. People are gloomy because when you go to the gas station to fill up your car, you're a little horrified. Well, when you pay that restaurant check, things are really expensive. And I think, especially for the average consumer, that can be a bit of a struggle. So that probably explains a lot of why the sentiment index is pretty low. So to kind of go through the bull and bear argument here, obviously the bulls are winning the day in terms of the market right now because the stock market is bouncing at all-time highs, and the bulls are saying, hey, look, earnings have been great. And the expectation is that earnings will continue to be great. So rah, rah, let's go, let's keep investing. And obviously, the bulls are hanging their hat on artificial intelligence or AI. The big argument is that because of massive productivity gains from AI, that will flow right to companies' bottom lines. And actually, what we are seeing is that, and we've never seen this before, companies are actually laying off staff, but still able to increase their revenues. Normally, when you increase revenues, you usually hire to support those revenues, but the opposite is happening today. So the bulls really do have a pretty strong argument with that. And as we went through, the bears have a pretty strong argument too, right? The market, they say, is priced for perfection, right? All we need is a hiccup, and they think we're going to see some trouble. They are pointing out the analogies to earnings growth after, when you're not coming out of a recession where earnings growth is this strong, it tends to disappoint. Bears think that companies are overspending on the AI build out. they are not necessarily of the belief that these magical killer applications will materialize that will justify all this spending. And obviously, the bears are also going to point to the fact that we have a lot of geopolitical uncertainty right now. Um, you know, our administration just recently had a visit to China. Clearly, Taiwan was a big topic of conversation. We obviously still have the Iran war going on. The Russia-Ukraine war is still going on. That is not the most calm environment right now in terms of, things could change in a minute. And then, of course, the bears are also hanging their hat on the fact that the Fed is in a tough position. And Kevin Warsh, who's going to be the new Fed chair, is stepping into a position where he's got a lot of pressure to cut rates, but it's going to be pretty hard to cut rates when you still have inflation that is not only above where the Fed wants it to be, but it looks like it's creeping up. And if the Iran war is not resolved soon, there's no reason to believe that energy, which is a big component of inflation, energy will still make inflation even higher. So what does all that mean for a portfolio strategy? Well, we do think that the bears have a little bit of an edge here in the argument, and therefore caution is in order. As a result, we are pulling back a bit. We are moving to neutral from overweight on emerging markets, especially after the great run that emerging markets has had. We will be moving to underweight U.S. equities across the board. We will be neutral on fixed income. Now, the nice thing about fixed income is because rates have gone up, yields are higher than they've been in decades. But if inflation still remains a problem, it is possible that rates creep higher. And if they do creep higher, that would be a negative on bond prices. So we want to stay neutral there on fixed income. Obviously, we do think it's important to have exposure to technology and all things AI. So we will be maintaining that exposure. We can't ignore that. So in general, though, now that we're past tax season, and congratulations to everyone who got their taxes done, it is time to think about whether or not you should take some capital gains, especially in your non-qualified accounts. And I do think it's important that we always reset our expectations. We've had tremendous years in the stock market, right? 2023 was great. So was 24. So was last year. And so far this year, we're arguably in double digits. So I think we need to reduce our expectations moving forward and get a little more realistic about what will happen moving forward. So with that, hopefully that was interesting, and let's go to some questions. Katie.
Okay, great. Thank you, Steve. Very informative as always. If anyone has any questions, please submit them now. We do have one here for you. It says, my advisor told me my account would generate lots of capital gains if my account was traded for this quarterly rebalance. Should I realize those gains now or hold off? What's your opinion on that?
Oh, wow, that's a great question. So maybe I'll step back and talk about how every account that we manage for clients here has a corresponding risk level, right? And so, on a scale of 1 to 5, 1 being don't want to take much risk, 5 being take a lot of risk. And so the nice thing about being in a retirement account is that if we rebalance that account to get it right back spot on to its risk level, don't have to worry about any tax consequences. But if it's a non-retirement account and the account has done very well, and for example, let's say the account was supposed to be a risk 3 and it has drifted into a 4 because it has the equity portion of that account has probably done very, very well. Well, if we do bring it back to a 3 on our quarterly rebalance, that will require, most likely, selling off high gain equity positions. And so then it becomes the answer to the question, Katie, is really it depends. And I think it really depends on the client situation, right? Are you in a position where it's okay to realize some capital gains? Say, thank you very much, stocks, you did a great job, and now I'm going to take some off the table and kind of rebalance. Or maybe your tax situation is such that you don't want to recognize any more gains this year if you don't have to, because that may depend on your personal situation. So one of the things we do here at this firm, and we take very seriously, is we are very tax centric. And so when we do our quarterly rebalances, we are always screening non-qualified accounts for how much gains will we potentially produce if we were to trade that account. And if that's a high number, we actually hold off, and we want our advisors to communicate with our clients about that before we actually recognize those gains. So I do think that that's an important point. And again, I think it depends on the personal situation.
Yeah, that makes sense. Thank you. All right, well, unless anyone has any last minute questions, that was the only one for today. Thank you, Steve, as always. And as Steve said before, please give us your feedback. There should be a survey in both the follow-up email and the browser when we end the webinar today. So thank you. And you can always reach out to us with your questions, and Steve's happy to personally answer them.
Thanks, Katie, and thanks everyone for joining today. And until next quarter, we'll see you soon.
Yep. Thanks, everyone. Have a great rest of your day. Thanks.